Finance Committee, January 17th. Subject before us is tax expenditures review. Ask questions about what we're done. Our witnesses, Patrick Tiverton, financial analyst from the Joint Fiscal Office. Welcome.
Thank you. So as you said, Patrick Tiverton, Joint Fiscal Office. I have a presentation that I know you usually like them up on the screen, so I'm just getting into Zoom now so I can share that.
Sorry?
The door.
Oh.
And Mr. Vice Chair, I am speaking at education in 15 minutes for a little bit. Yeah, right. Oh, that's right. Okay.
Great. All right, so I am here today to talk to you all about tax expenditures. We just wrote the 2023 tax expenditure report, which we do every 2 years. And that we go in and estimate, what the state is not collecting due to various exemptions or credits or deductions or what have you. So I guess just to level set, tax expenditure is a statutory provision which reduces the amount of revenue the state would otherwise collect without it, right? Usually done to encourage certain activities or to limit the amount of taxes collected from certain groups. If you're talking about encouraging activities, earning from tax credit, often used like an incentive to work, or it's an encouragement. Things like groceries, clothing, they're exempted for the most part because they're consumer staples and they make up a large budget, like portion of a household budget, particularly among lower income households. So we can't get data or estimates for every single one. Sometimes run into suppression issues with the tax department with there aren't enough filers, or there's just not good data out there to come up with an estimate. But we do as many as we can. You'll see that there's a lot in this presentation. So I already mentioned some of this, but in addition to the tax expenditure report, we also do a review report where we go and pick, based on sort of a rotating schedule, a particular credit or exemption to do a deep dive on. This year, we did the earned income tax credit, which hopefully if we have time, we can start talking about that one after this. And then we also got 6 expedited reviews, which were pulled together from tax. It's kind of the same general thing, but much more condensed and shorter form. So just to start setting the stage, this is sort of all the estimatable tax expenditures. This is the amount that was not collected. So this is the cost of these tax expenditures for the state in fiscal year 21. You see $580 million in sort of, you can think about it as cost or a foregone revenue. And over half of that, the big bulk of it is from a lot of the exemptions that we have for sales and use tax. I think a couple slides before the example, couple of the examples, which are big ones, are groceries and something stuck in my throat.
Expenditures, would you say another term is like carve-outs? These are carve-outs that we don't collect taxes on.
Yeah, I think, particularly with like sales and use, products that we're not collecting sales and use on, I think that's probably an appropriate way to think about those. But you'll see as we go through, I'm not sure that'd be an appropriate way to think about like the child tax credit, or particularly like credits, refundable credits, that kind of stuff. Another example where maybe it is appropriate to think of as a carve out, we'll see when we get to like property tax exemptions later on. But really it's good to think of them sort of as a cost to the state because it's foregone revenue. It's the same thing as you were collecting it, you spent the money. So we're going to go through sales tax, property tax, personal income, corporate income, meals and rooms, everything you see on the screen here. But I guess to start, we'll talk about personal income tax, and there are a few new tax expenditures, which were in Act 138, which I think was H510, if you recall, from last year. So, and then there were some expansions of existing expenditures. So new ones included the child tax credit, student loan interest deduction, and then the civil service retirement system and military retirement threshold exemption. There were some expansions for the child dependent care credit, earned income tax credit, and social security exemption. At the time, these were our estimates that were conducted for those new credits. So this is what we were forecasting or anticipating those to cost. And you can see immediately, the child tax credits can end up being one of the highest tax expenditures for the state, like single item. That's almost 32 million by itself. We don't have any hard data on that one yet from tax, but I think even after maybe sometime this summer, we should actually be able to start seeing what it's actually costing rather than needing to estimate it. So I guess more to come on that. And then this here, I have a big table with a lot of line items, but it's more maybe helpful to look at it this way, sort of in a condensed format. You can see overall personal income tax expenditures total about almost $90 million. The largest single item currently in this bucket is the earned income tax credit, and you'll see, from a slide previously, child tax credit when that comes, when we start including that, that's gonna, effectively, it looks like match or be a little above already existing largest credit that we have. So we do anticipate this number to go up in the future. I guess I'll just pause briefly to see if we have any questions so far.
Earned income tax credits and child tax credits, are they refundable tax credits?
Those are both fully refundable, yeah.
So the purpose of bookkeeping, they behave like appropriations, do they not?
It's an interesting way of thinking about it. I'm not sure I had considered it that way. I mean, yes, if there's an instance where someone has a negative tax liability because of one of these expenditures, the tax department will actually send them a cash check. I'm not sure how that gets considered when they go to do the books, like in an accounting sense. But I could call
They being
the tax department, or how, or the treasurer's office. But yeah, it's an interesting point.
Child tax credit, was that new last year for the state of Vermont?
Yes. And that one is, there's certain income thresholds, phase ins, phase outs, but it's $1,000 per filer.
What you're saying in terms of the tax credit, if it's a refundable, just that portion that's refundable will be accounted for obviously differently than the part that is simply money not received. So
For many who've been on Ways and Means and Finance for years, tax credits were deductions and things that you paid in lieu of paying taxes. But refundable tax credits are paid to you regardless of your
there's
income.
another offsetting interest.
Yeah, much like appropriations.
Yeah.
There's a benefit. There's a benefit rather than.
It's money, yeah. As Yogi Berra would say.
And I know it's a fact, I don't want that.
It's cash, just like money.
So the 29 million on the screen here, that would be inclusive of both the, the amount of tax that's being offset and any cash amounts. So it's all inclusive. So it's not just counting tax that's not collected. So just to sort of put it in perspective, in fiscal year 21, the state collected about $1.2 billion in from personal income revenue. Just to sort of put that in perspective against the 90 billion that the state's not collecting.
Is there something particularly descriptive about cumulative actual? Is that just like the annual?
That's yeah. So that just means, for the fiscal year, so fiscal year 21, July to June, that's how much and I have the word in there, actual, because that one's not an estimate, we know that number. But so for a lot of the other stuff, it's, you'll particularly see in sales and use tax section that those are all estimates. We got a lot of hard data on other things from the tax department, but I sort of try and label them just so you know we're kind of working to come up with a number or where we actually get an actual number from tax.
Sorry. Because we're using fiscal year here, but people pay their income tax based on the calendar year. Is there a big discrepancy or difference in the figure between the first half or the second half of the year?
Well, I mean, the first tax filing deadline is in April. A lot of people will, file for an extension. And so there are changes throughout the year, depending on when you pull some numbers. And actually a good example is, so when we were working on the report for the tax credit, we had a taxable number for us, and that was in October that they pulled that. When we're writing this report, they did the estimate, they pulled the number again, and that number was slightly different. The reason for that just being, more had gone out or been collected, through enforcement actions, what have you. So the number, it does change a little bit from when you're actually pulling it. But if you just take it from at the close of the fiscal year, this was the amount. That shouldn't change.
But COVID, for example, probably made a difference in tax revenue by fiscal year as opposed to tax revenue for calendar year,
Right.
because of where COVID actually hit during 19 and 20, or over 20 and 21.
Yeah, and they
Look at it that way, yeah.
They had the additional extensions because of COVID as well. So I haven't done the sort of a forensic analysis looking at how that differs over the course of the year, but there are some differences depending on when you pull data points. So if we're all set, a tax expenditure that we added to the report this year that has not been included in the past was for the VEGI program, which provides incentives to businesses to recruit and expand their capital investment, capital investment, and they're paid out over a period of 5 years. So you'll notice, we've been talking a lot about fiscal year 21. A lot of our estimates are for that year because there's sort of that lag. We don't actually have data for the most current years. So as sort of a compromise, we've got the last 5 years, which are included in the annual report on that program.
That's fine. Again, the incentives paid in 2020, this then we don't see anything that results from the COVID era, because that data is not here yet.
Right.
But I would expect that you would see, as it goes out to 21, it's probably going to be a fall, I would think.
I mean, I'm not sure. I could speculate, but there might be something to that, yeah.
I think I need a primer on this, but I'll do that offline.
Yeah, Probably have Emily Byrne come in and take it into one of our, she knows a little bit more about it than I do.
Now, if you've been fooling with veggie for a long time, one of the things that you noticed is there was a point in time, I think it ended in 2006 or 2007, but before that time, we were paying out the estimate on the basis of essentially what was estimated, what the company said it was going to do and save and so on and so forth. And then we found that the company went out of business, it didn't do what it said it was going to do, whatever the case, and then we had to try to claw back the money. And that was a nightmare. And so it got changed to a retrospective review, which made much more sense. Remember that, Mark?
Yeah. But originally it was, your benefit was that if you did certain things, you didn't have to pay as many taxes. And veggie has changed now to, if you do certain things, we send you money, which is, we send you cash. And who decides whether the cash businesses receive has been
When working that,
earned,
stuff that can be
has followed the procedure?
I would imagine that's something that the auditor's office would undertake.
I don't know if the auditor's office does that. Why do I think it's a tax file? I don't remember the detail of that, but it's somebody who does it. Veggie doesn't do it itself, and I think it's the tax department.
It's not Betsy.
I don't think it is, but like, again, we get into it more, I just don't remember the details.
There might be a question,
But it's not the auditor. The auditor does an audit.
who signs off on how much a company has been authorized to receive?
Yeah, so I mean, they do have an economic cost benefit model that they use in conjunction with Tom Cadet to establish how much the incentive should be.
Signs off that cost benefit model has been followed, and this is the dollar figure.
Well, so they do have an annual cap that they can go up to, and they have to get permission or approval from JFC if they want to join fiscal committee.
But there is a review in mind. I don't remember whether the review is the tax department. I'd have to go look. I just don't remember.
Somewhere someone has to meet
Yeah.
and say,
Yeah.
Jones Company has
And they in fact did it.
has
Yeah.
earned this tax credit because the numbers that we're passing out at the table show that they've earned it. What's that mean? Who is around the table to sign off on that? You don't have the answer now, but
Yeah.
would be worth learning.
So Betsy they're the ones who sort of do this work in-house. They're the ones who operate the program. So they would be the ones making the decision, sort of thumbs up or thumbs down.
Why do I think though somewhere along the line is the tax department review? Before it's not just an automatic payment.
That could be true. I don't know.
Again, I'd have to look.
I think I was just appointed to Betsy, and so I'm gonna find out.
Yeah. Would you testify for us before the next meeting we have on this?
Let me work on that.
But I guess circling back to the report, this is a new thing that we've included for this year, and we'll continue to update as every 2 years when we update this report. I guess moving ahead to corporate income tax, you can see that there are a lot of asterisks, that's a tough word, on this table this year. Those relate to suppressed data, meaning that there were fewer than 10 taxpayers who even to the point where, you see that last line at the bottom there. Usually if we smash all those suppressed items together, we can get up over 10 and, at least report what the suppressed number is. But this year I guess there's just not many people claiming these other credits. So all we really have to look at this year is the research and development tax.
Well, that suggests though that there really isn't anything to amount to it. If the bottom line total is the same as the research and development tax credit, it would say that all the others would have to be zero. I'm just wondering if that's correct,
So
or if they're just small amounts that,
So, yeah, I mean, we can't total any of these small amounts.
Yeah.
If it's suppressed, the tax department won't give it to us.
they won't even give you the aggregate?
In this, so in some cases, so we'll see in other tables that we're actually able to get sort of all those suppressed items smashed together what the
Yeah.
total cost is. But this year, even when they put them together, it still doesn't come out to over 10 filers. I did sort of needle the tax department a little bit to see what I could find out about the suppressed data in this category for this year. And they said, close to getting to the 10 filer threshold, and it was, I think the phrase was, not close, not particularly close to the number you already see on the table, was how they phrased it.
So not particularly close.
Yeah, sort of vaguely phrased on purpose.
But they can give us the small number.
They legally can't give you the, or us that number if it's,
One
again,
person, oh, it tells you who it is.
yeah, because they have to suppress it because of disclosure issues. So it's not that, it legally they can't.
Well, does that mean, though, that if there are less than 10 issues of the affordable housing credit, and there are less than 10 taxpayers involved, if the actual total of that is $50 million, that they couldn't add it into the aggregate bottom line?
And yeah, in theory, that would be correct. I don't think that that's the case here.
It isn't, but the notion that it could be, that we have, if we have no idea
Yeah.
what the total of all of these things are. Right, that's worrisome.
But might it be appropriate to meet an executive session so that we could actually see this data without disclosing it to the public? I mean, we're in an oversight role here.
I can't remember ever
Okay.
having met in executive.
I don't think the legislature meets in an executive session.
I just feel like we should have access to this data.
I would
That is
encourage
not
you to
your
reach directly to the tax department on that, especially, coming from me, I'm not a lawyer, so I can't speak.
I mean, committees of the legislature do meet in an executive session. The IT oversight committee that I chair, we meet in executive session regularly when we're dealing with data security issues. And
I don't think standing committees do. I mean, like,
I don't know why we couldn't, but again, the law
we're doing the
as
people's
such,
business.
may still preclude them from disclosing it, but I believe it does.
Yeah, I think I would encourage you, if you want to pursue that kind of thought, to talk directly to the tax department about it.
Yeah.
because,
Yeah.
I don't want to speak for them. So like we saw for personal income, this is just how, what we were able to estimate stacks up against actual revenues for in the corporate income world. So, I guess the percentage of total for personal income was a bit higher. This is sort of not very, it's relatively small compared to what we're actually bringing in. So if we're good, that we can move into the sales and use tax world. So I just have a list of everything that we estimated for this year. It's a lot, and I do say the word estimate intentionally because, unlike with personal or corporate income, where the tax department can actually go and see what's on the tax form everyone handed in, we have to go out and see what's the market, how are people spending their money. So it's sort of an educated guess.
And this was something, that I know when we did the Blue Ribbon Tax Commission, or not the Blue Ribbon, it's the tax commission that did after the Blue Ribbon, that started, that looked at sales, just the Blue Ribbon Tax Commission looked at sales taxes. And that was one of the issues, is just the list of expenditures for these, are all these expenditures really appropriate? Why would sales by auctioneers be exempt from sales tax?
Tradition.
That was probably, somebody had a friend who was an auctioneer and was sitting on the committee, but why aren't those things included?
Yeah, I mean, I guess going back to the view of tax expenditures, I mentioned they're either to encourage some kind of activity or
Advertising materials are exempt.
There for most, if not all of these, there's not specific statutory intent for this particular product, the way they do for something like veggie has this explicit statutory intent. So beyond saying historically, that's just kind of how it's been done. That's kind of where we are with that.
You gotta tax newspapers for sure.
Some of them.
Yeah.
You had an explosion in the committee to try to do that.
And I guess one thing you might notice here is, so in the sales and use tax world, there's product level exemptions,
Yeah.
but also entity level exemptions, like you'll see 501c3s, nonprofit organizations, they have some sales and use tax exemptions on their entity level. And yes, your railroad rolling stock and depreciable parts.
And it took most.
On there. And we did estimate that one too. To go on. So this is sort of a look of the largest ones. So sales of food, obviously being the biggest, that's an exemption because it's makes up a large portion of household budgets, which is sort of the intention behind that. I think that contributes over a third of the total exemptions in the sales and use world. But I have 4 other large exemptions listed here. But so after we saw that big list of things, 5 of them are making up the bulk of the expenditures for the state. So everything else is sort of squashed into that all other bucket there. So looking at the cumulative revenue, which all goes to the education fund, last year collected 5.8 million in revenue from that source, compared to the number you saw previously, the 300 million in expenditure for fiscal year 21. As sort of a comparison, this one makes up a higher portion of the market, just because a lot of things that are considered consumer staples are included in those exempt, specifically because traditionally the sales tax is a regressive tax, so it's a way of sort of offsetting the regressivity of it for lower income households. If we're good, we can talk about meals and rooms. And this is always a section that's this is another one we have to estimate. It's very difficult to get any kind of data for a lot of these exemptions. You'd be hard pressed to sort of convince me that any of the ones we don't estimate are particularly large. But it's a world where there's some things we just can't get data for in this area.
But in housing, I would think would be a large number.
Well, so that has an exemption so UVM has some exemptions from the property tax, which does show up. So it is captured as an expenditure in other ways.
The big one, top one, can you just elaborate on what a grocery type item furnished for takeout entails? What is that?
Yeah, so, okay. This is always a threading the needle kind of definition. It has to do with when you go to the grocery store and I think it would apply to something like a rotisserie chicken, or if they have like a warm buffet kind of bar at a place like that.
Or deli sandwich.
Or a deli sandwich, yeah.
This was argued at infinitum years ago. And I think that this is the so-called bagel tax.
Bagel tax.
The bagel tax. You get the sandwich to go.
Are these expenditures that we lost the revenue?
Yes, these are things that are not subject.
They're not taxable.
Yeah, these are all things that are exempt from the meals and rooms tax. So they're not taxed.
Now I'm confused. The grocery type items furnished for takeout, I thought that was the bagel tax and that we do tax that.
We can actually, if you want, we can come out of this presentation and go directly into the report, because there's some language on,
Okay.
if you want to find that maybe. So I'll make a note.
Or maybe furnished for takeout means you're buying it, you're gonna bring it home. As opposed to, you're only gonna eat it there or eat it out on the sidewalk. In which case, it's,
Maybe,
the grocery store is acting as a restaurant.
maybe we'll have it read to us, but it was,
I thought that was
Before you leave this slide, I just want to clarify, what does that 7.4 million represent? That was a lost revenue stream, that's not the 7.4 million expenditure that we did not collect, that if we taxed grocery type foods for furnished for takeout, we would get 7.4 million.
Yes,
Just to clarify.
exactly. And so, yeah, that's a good way of anything in from the sales tax portion of this, anything here, these are things that are not taxable. They're exempt from taxation. So this is all of this is sort of foregone revenue.
Quick follow-up. I hate going over ground that's already been covered in previous sessions, but I always thought that when I bought a prepared meal, that I paid meal tax. So I guess I'd love to understand what rationale previously was argued for this, and if this is the $7.4 million we should look at.
what are the circumstances where prepared meals are untaxed?
Well, I think anything you get out of the freezer section, like a TV dinner that would be considered.
That's groceries.
Right,
Not taxable.
right.
McDonald's hamburger purchased at McDonald's,
That's gonna be taxed.
a Wake Robin hamburger purchased at Wake Robin,
Is Wake Robin a restaurant? I'm not familiar with that.
No, assisted living facility.
Oh, that
sort
would
of in a
be,
continuing care retirement
the
community.
cafeteria at Wake Robin.
yeah, so that would fall under the served in hospitals, convalescents and nursing homes.
Not
That would
taxed.
not be taxed. So that would fall under one of the categories we have here, so it's not being taxed. Fat burger is not.
So one of the questions that I've got is take the served in hospitals, convalescent and nursing homes. If you're talking about the meals served to a patient, what about the meals that are sold in the cafeteria, for example, at UVM Medical Center? And those can be sold to the public or whoever walks in the door.
So I think in that scenario, they would be taxed.
I
It's not a
don't
food
like-
court, right?
Yeah, exactly.
So,
I see a distinction between a frozen item, which requires some preparation. You have to heat it up. It's frozen. I've never eaten something out of the freezer just straight, but I see different with rotisserie chicken. Well, ice cream,
Ice cream
you still gotta put it in a bowl.
today.
Yeah, but I feel like a rotisserie chicken, it's prepared and it will expire that day. So I feel like that's different. I guess if we're looking for money, I'd like to better understand this.
yeah, so the definitions are always very specific and at the same time can be confusing. So I think what I would prefer to do is, instead of trying to quiz myself, I'd like to actually look it up and make sure I'm getting the correct information. So sort of cumulative view again, bringing in actually bringing in about 135, and then the sort of foregone revenue that we've been able to estimate is that 9.6 figure there.
And it could be obviously a lot higher because there's so many categories that aren't estimated.
It could be, it is high, so the actual is going to be higher, so.
Okay.
I mean, this is an estimate, and the actual, it's not including a bunch of categories, so it would be higher. To what extent? I don't think it's double.
No.
But. So then moving into property taxes. This is an area where we had about $100 million in foregone revenue or tax expenditures in fiscal year 21. You'll see here, made the point about UPM earlier. They would be falling under this VT colleges in UPM wedge of the pie chart. A big portion of this total expenditure is coming from, we have them listed in the report as pious entities. So that would include the charitable organizations, private colleges, and then just pious organizations, hospitals, and the private public schools. So that makes up about, I think all those together is a little over $60 million. So that's more than half of what's included in this area. Just a quick note, So I mentioned about the pious nonprofits or government entities. And I guess just as a note, it's a lot of these things, because of property taxes, this is a specific expenditure for the education fund. Just, and again, meaning that it's money that, or property that the education fund is not able to tax or pull in tax revenue for.
So that's colleges and universities.
Yeah, so there's a lot of, so colleges, universities, and you can also see in here, there's charitable organizations. Pious organizations could include like a church.
I'm talking too much. So this is for, but there are municipal pilots, payments in lieu of taxes, but that's not really considered. This is just education fund redirects.
Yeah, so the pilot fund, yeah, that's sort of a different ballgame because that's funded through property transfer taxes.
Tagging on to that, the one thing I'm hoping to see in the childcare bill that I would love this committee to consider is I don't think we should collect taxes from spaces that are dedicated for childcare, including businesses that dedicate square footage. I'm going to advocate for a discount on their education property tax expenditures based on how much space. I think of Vermont Information Processing in Colchester, Vermont. They have for 30 years had a childcare facility in their building. I wish they would get a deduction on their property tax for that and to incent other employers to have on-premise childcare. So.
Yeah. But Eagles clubs.
I'm not sure.
Elks.
They're nonprofits.
Yeah.
They're nonprofits, I think.
Pardon?
They're nonprofits. And there's a blanket exemption on probably ones from similar organizations. It's called, are they considered? They're not 501c3s, but
American Legion.
yeah. Yeah, I don't know.
Moose Club.
Moose. Okay.
Now, didn't that come up as a controversy a few years ago?
Yeah, that's what I was thinking.
I don't know the answer to that off the top of my head. And I have to check with one of the lawyers just to make sure,
You double check it. Of course.
double check. But yeah, I have a note in here about the Elks Club. Were there any other ones that I have a note about the Elks Club? Were there any ones you want to know
Oh, they're all-
specifically about?
I think the fraternals in general are tax exempt.
Yes, they are. So not included in sort of the pie chart is there's a line item. So that would fall into the other category. So things smashed together.
Which one?
Fraternities.
Fraternal organizations, elks, moose,
Well, that's,
lions.
You know,
those are different than fraternities, which are owned by, corporately owned and then leased to the individual campus fraternities.
Yeah, I don't know about fraternal, I was talking about the fraternal organizations. The raccoons. Remember Ralph and Ed?
The honeymooners, okay.
So I know the answer to the question is in the report. I just don't know it off the top of my head. There's a lot of specific language in there for so many of these expenditures.
Maybe we get Scott.
But if we're okay. Your question?
Nothing prohibits any legislator from coming in and offering a bill to exempt any particular organization in any particular town.
Yeah, that's a policy decision for you all.
That's why you have a list of Lawrence, a list we saw on the earlier page.
Right.
There should,
I want to preface this by saying I'm not advocating for it, I'm just inquiring, but I noticed the biggest pie slice was the pious organizations. Do you have any understanding of how many other states do tax or collect education property taxes from pious organizations? Are we out of step? Churches.
Yeah.
Well, property taxation from state to state varies quite a bit. So I don't know, how we compare to New Hampshire in that regard, but I can certainly look and see just to.
I'm sure the NCSL has
that could be, they could have something on that, but, you know, off the top of my head, I don't know, if, like New Hampshire, Maine, include their exemptions.
And they're one of our cases often brought here is mentioned is the Orvis Fly Museum as being educational, like any other museum. It's Fairbanks Museum of St. John's.
There's one down to Orbis. I don't know what committee it was.
So I guess that is what I have for property taxes. Our next section here is the bank franchise and insurance premiums tax. I guess just as a reminder for the committee, the bank franchise is a tax on the average monthly deposits held at banks. And it's at a rate of 0.000096. So it's a very low tax on, sort of a large amount of money. And then for insurance premiums tax, that's 2% tax on premiums.
That's money that is actually in the bank overnight, is that correct?
Yes, so it's the monthly average deposits held.
Many big retailers have programmed their machinery and bank deposits to remove all the money by 5 o'clock in the afternoon and send it to a state that doesn't tax that stuff.
Is that right?
I believe that's an accurate, that Walmart, for example, does not leave money in the bank overnight. It has the capacity to send somewhere else before the deadline for having to pay the overnight tax.
That's interesting. I didn't know that they did that. So it sounds like a lot of work.
It's a lot of money.
Yeah, right. So one thing I want to point out this year, you'll see that the data for downtown and village center program tax credits, that this year that data has been suppressed, unfortunately. So we don't know what this particular line item is. Historically, this is something that's always been included in these reports. It's just there aren't a ton of banks and insurance companies that are buying these credits and then claiming them against their tax. This number was also suppressed in the corporate income table. We're working with tax to try and find some kind of solution where maybe we can write a sort of special report on that program where we take the total amount and smash it together. We won't be able to know how much was for bank franchise or how much was for insurance, but we'll at least know what the number it was for fiscal year 21.
This is what you're telling us. New?
These are not new.
Right, they aren't new, but when we vote on a budget here, we're told how much that costs us.
Yeah, so there is so we'll be able to get the information.
That's not smashed together to tell us how much it costs us.
Well, so there's a cap, obviously. So there's an annual cap of 3 million. Last year, you did approve a 2.45 million increase for a 2-year period. So we do know what the caps are. But if you want to know the specific dollar figure of what was actually claimed in the credits, we're gonna have to work something out with tax to put those pieces together so we don't have to suppress that information. Well, it's not us suppressing it, so we can get it essentially.
That's the chair. How should we do that?
Yeah, so we're working through it with the tax department right now to figure out what they will be able to do. Again, it comes down to a legal question, but we're hopeful that we can, come up with some kind of special report in the near future for that, specific reason. So again, putting it in perspective, what we brought in, what we're foregoing, bank franchise last year from, you can get all this from the consensus forecast from Tom. 13.9 million was actually brought in, 6.4 was not brought in. So that was the tax expenditure amount. Insurance premium, higher, so about $60 million in fiscal year 21. And then 27 was the amount of the tax expenditure for that category. And then lastly, this is the last section of this presentation. In the motor vehicle and fuel world, you know, $500,000 was exempt or was not brought in due to diesel fuel expenditures. If you've ever been at the gas station and know the dyed fuel for the off-road uses, that would be that exemption right there. And then the motor vehicle purchase and use world, you know, there's a lot more here. It's about $45 million. The largest of that being the trade-in allowance, but it's kind of funny thinking about the trade-in allowance because I think you can maybe more accurately view it as avoiding double taxation. So when you bring your car to the dealer, they'll trade it in, they give you how much they'll give you for it, and they reduce the price of the car you're purchasing by that amount. And when they do that reduction, that's also reducing how much you have to pay in purchase and use. But then on the flip side, the dealer will then go sell that car that you just traded in and they'll collect purchase and use on that transaction. So it's really just a way of avoiding double taxation. Jake Feldman actually wrote an expedited review of this in the reviews report, if you want to learn anything more about that. Sorry.
Is there any concern that that's abused in any way? Because the dealer can give a higher trade-in and then just use that to reduce the tax liability and have it come out in the wash. 45 million bucks. I'm wondering if there's.
Yeah. There's a little bit more detail about it in the expedited review from the report. I don't have that included in my slides about the review report.
Not that the dealers would abuse, it's a way to lower your tax obligation by giving a higher trade. I feel like I put qualifiers on YouTube all the time or else I get nasty emails.
So, you know,
You trade your vehicle in for X amount of dollars against a new vehicle, then the purchase and use tax on the new vehicle is what you paid for minus X. It's supposed to come out. The big problem on that one was having to deal with rental cars. Because the dealerships often owned the rental cars. And they didn't want to pay the purchase and use tax because it wasn't, their car was being driven by
so
Wrangle.
in the gas and diesel realm, you know, about $87 million of actual revenue comes in every year, which goes to the transportation fund. So the foregone revenue in this area is very slim. It's just, you know, it's under $600,000. Purchase and use, much larger, about $90 million of actual revenue that comes in. And then that 44.8 million figure, you know, like we just saw, the bulk of that is from the trade-in exemption, which I think, you know, Jake says this in his report, but I think it's sort of fairly viewed as more of an avoidance of double taxation than sort of an explicit tax expenditure. And so for this report, that's all the slides I have. But if we have any other questions we want to look at on this report before we start talking about the PITC. Next one, go ahead. All right.
Can I just, something I missed, can you tell me how much public pious and charitable is up to? Do we have that as one number?
14
Just 14 million?
Pretty big slice of the pie.
So there's sort of a subgroup or like a overlay group and then a subgroup. Pious is includes things like, the way it's defined in the report, it includes things like charitable organizations, private colleges, pious organizations, private public schools, and then hospitals also. So when we add those together, that's like 62 million.
In property tax, foregone property tax.
Yes.
Or moves and meals.
Where's the mail? Oh, you mean like the hospital meals?
Yeah.
Oh, okay, I was like, what? Are we trying
We
to
brought up an
church
issue.
meal money?
The nursing home question. But if you're just looking just at IAS organizations, that's the 14 million that Senator Chapin is referencing.
And that's just churches and
Yeah, the
religious.
Do you know if other states tax that?
Some do. I think some do and some don't.
I'm always interested in the pious taxation, and they may set standards for different definitions, but especially if you're engaged in political.
So I know from Jill and Senator Cummings that you do have a hard stop in like a half-ish hour. So so I guess we can go as long as you guys have the stamina for it.
It's not very long.
I know, I was gonna say.
3:45 has been canceled.
So this presentation is sort of broken up into chunks, so if there are a few sort of pause points that we can, address if you guys want to keep going or not. The first 10 or 15 slides, something like that, are really just have to get everyone on the same page with the context behind it and how it's calculated, because we do have to start at the government or at the federal government level and work our way down, because the Vermont credit is structured as a flat percentage, but we'll look at all of that. So we just talked about the tax expenditure report. It's due every 2 years. Also due every 2 years is this additional report, tax expenditure review report. We usually do 1 or 2 full reviews, which this year our full review is on the EITC, and it's a kind of a deep dive, long form report format evaluation of the credit. But we also include expedited reviews, which were much more condensed, much shorter, not quite as meaty. So we had 6 of those this year. The tax department was the one that, just the way it shook out this year. They completed 6 expedited reviews, and JFO also with their assistance, particularly the data world. We wrote the long form, and in it we'll go over everything, but we had 4 major findings, which I think are very interesting personally. And then all the way at the very end, we have 3 considerations about the credit, just for food for thought for you all to think about. So the EITC is established in Title 32 of the Vermont statute. It works by reducing personal income tax liability for filers based on their income level, marital status, and how many dependent children they are claiming. And then the statutory purpose, just it'd be good to sort of internalize this for everyone as we go through the report, because a lot of the analysis is based on evaluating how it's doing in that context. So for the EITC, it's to provide incentives. So that's part 1 for low-income working families and individuals. And then part 2 is to offset the effects of traditionally regressive taxes on these people. And we directly address that in our findings 1 and 2, which we'll get to later. So just as I said, we have to start sort of on the federal level before we get down to Vermont. EITC was established on a temporary basis in 1975 before being made permanent in 1978. Vermont, we started our EITC in 1980. That's a flat percentage. So federal level, they figure out what your credit is. That flows down onto your Vermont return. And Vermont says, okay, you get at this % of what your federal is. And so in 1980, for even more additional context, Vermont also calculated personal income taxes by as a percentage of your federal tax liability. And at that time, if you had $100 in federal tax liability, you were paying $23 in Vermont tax based on that. So the term there was called the applicable percentage. That language has since been repealed, but the structure for the personal income tax has obviously changed. We don't do it that way anymore. But sort of this is how Vermont kind of got to this point of just applying a flat percentage to calculate the EITC. Good there. So because Vermont just applies EITC as a flat percentage of the federal EITC, eligibility criteria and maximum credit amounts are established on the federal level, and Vermont doesn't have control over those. We only have control over that applicable percentage. Today, that percentage is at 38%. So if you get $100 credit from the federal government, you're getting 38 from the state. And that was last increased just last year in Act 138 from 36 to 38%. And I guess, yes, just to reiterate, any changes that are made to eligibility, credit amounts, any of that flow directly down into the Vermont credit. So getting into how, what the eligibility criteria and credit amounts are, because the Vermont EITC piggybacks, and I've already said that. So there's 3 primary criteria that individuals need to meet in order to qualify for the federal EITC. They have to have earned income. So that it necessitates work so that they're receiving wages, salaries, tips, that kind of pay. So they have to work, but they have to have adjusted gross income within certain ranges, depending on their filing status and how many children they have. You can see the table below. That is what the 2022 federal AGI thresholds are for this. So if you are a single filer and don't have any children, if you are earning more than $16,480, you do not qualify for this credit. And also the third criteria, you cannot have investment income greater than $10,300 in a tax year. We're good. So that was the 3 major eligibility criteria. Moving into what the maximum credit amount is. That is dependent on how many children you have, regardless of filing status. So we'll see an example, maybe on the next slide. Oh, in a couple of slides, we'll see an example. There's a phase-in range, there's a plateau where you're earning your maximum amount, and then as you continue earning more, there's a phase-out range. And so this is kind of a table version of that quick explanation. That credit rate is your phase-in rate. So for every dollar, so again, if you're unmarried and no children, for every dollar you earn in the phase-in area, you're getting 7.65 cents for every dollar until you have earned income of 7,320. That's where you are. At that point of earning, you're going to be hitting your maximum credit amount, which is that 560 figure. It's going to stay at a plateau. So the plateau here is about 7,300 until you get to about $9,100 for income. For that entire stretch, you're earning your maximum credit amount. So then on the back end, you have a phase out rate. Every dollar of income you earn beyond your phase out amount threshold are reducing the amount of credit that you receive. And so that continues all the way until it's 0. So that last line in the table, that's how much earned income people have when their credit has completely zeroed out. And just as another way to visualize this, you know, on the x-axis here, we have your earned income, and then on the y, we have the credit amount. You can see there's that phase in up until you're reaching your maximum credit amount. And then once you're past that plateau, it's phasing out. And so that's, again, how the federal government has structured their EITC, which Vermont flows directly down here. Looking at sort of high-level Vermont figures, so this is the total value of the EITC by year. You can see it's generally a bit volatile. These numbers are not adjusted for inflation. So if we were to do that for everything in 2022 dollars, you'd see those bars at the left end probably come up, you know, relative to the ones on the right. Again, that's somewhat volatile. One thing that you'll notice in this table, though, it was a There's a jump right here in 2018. So that was the last time. So 2018, the Vermont applicable percentage was increased from 32 to 36%, I believe it was. And then again, so last year it was increased to 38%. The other big spike we see here is in 2021, where we see a huge increase in the, it's going from about 25 million to 28.6 million dollars was the tax expenditure in that year. And the reason for that had to do with changes made at the federal level towards eligibility and credit calculations for single filers. We'll get into this a little bit more later on, but effectively what they did was they greatly increased how much income you could have if you were a single filer and was to receive the credit. And they also effectively tripled the maximum credit that those filers could receive. So if that's the total, if we move on to average, you can see that on a, from 2010 to 17, it was sort of, increasing a little bit every year until 2018 when there was that big increase, 38%, from 32 to 36%. So that explains the increase in that year. Interestingly, though, you see that, so remember we saw the total credit amount jump quite a bit in 2021, but the average credit amount actually dropped, which again has to do with the federal expansion of eligibility and credits for single people. So there's a big influx, which we'll see later on, of single people claiming the credit, but they on average get a lot less out of the credit, even with those increases in the maximum credit amounts. So it's a big influx of people who are getting credits on the low end of the spectrum, which brought the average down. So we are all set. We can start to look at what the demographics of who claims the EITC look like.
I better stand. So they'll make people nervous by standing during parts of the meeting just to stretch the muscles.
I used to work at, we'd have 30-minute reminders to stand up.
We should have that.
We had a colleague who used to stretch out on the floor.
Right.
Those back hurt.
Start doing that.
So, generally speaking, the largest cohort of claimants have always been head of household. They make up, for a long time, they made up about 37 to 41% of total claimants. In single people, they've been pretty much about the same over that amount of time, between 33 to 38%. It's not until those changes in 2021 with the big, federal changes around single people that we see the number of single people, the share of single people really surge because of their newfound eligibility. But historically, for a long time, the most claimants have been head of household for the largest portion. And so I guess just as a
Oh, no, go ahead.
I was just going to say, just as a quick reminder, head of household, it's an unmarried person who has a dependent child that they provide at least 50% of the financial support for. And so there's a question.
Why are widows and widowers different than single people? And they don't seem to be here.
So it's a good question. It has to do with it's a sort of a legal definition for filing your taxes. If you were qualified to file under that status, if your spouse died within the past 2 years, I think it is. So once, by year 3, you then go start filing as a single. And I think, yeah. So again, 2021, those changes at federal level that had the largest impact on, just sort of the composition of who's claiming it.
Is that going to change? I'm kind of missed if that's like.
So those changes for ARPA were temporary and for tax year 21 only. So for tax year 22, everything's reverting back to what the structure was before for single people. So I think likely what you're going to see is sort of a reversion back to any of these bars prior to 21.
And that's the number of claimants, but the head of household probably earn the most, like dollar wise.
Head of household actually we'll get into this a little bit more later, but they make up about 8% of total, they make up of total taxpayers in the state. 8% of the tax returns are filed as head of household, but you see here that 41%, so they're dramatically overrepresented, so and we'll see some data on this later, they're actually persistently lower income. So this is like your single parents, they're persistently lower income because they're persistently falling in the income thresholds needed to claim this credit.
And so I thought that meant they got the biggest amount because single people overall, they get a smaller return even if they're eligible. They get only 500 or something.
Yeah, so actually, I hate to jump around too much, but let's just go back and look at so these maximum credit amounts. So if you're single, the second that you have a child, you're going to start claiming this head of household. And you can see that there is a very dramatic jump, both in your income threshold and in your maximum credit amount. So yes, that's part of why we saw when we were jumping around again, when we looked at this average EITC, that's why when we saw that influx of single people in 2021 because of the federal changes, we saw that average come down even though total EITC amounts went up because they are, as you said, getting a much smaller credit amount even with that expansion.
I just interviewed a slide that was like the amount covers the number of claimants.
Yeah, so what I have for major findings, so the first one's going to be looking at regressive taxes and how well we're doing with that. The second major finding is going to look at incentives. So that's that second part of the statutory intent. Our third major finding is going to be a deep dive on head of household, because there's some interesting data that we found on that. And then the fourth one is going to be a deep dive on single filers and how the expansion from ARPA changed.
And you aren't going to do that today, right?
Well, how late do you want to stay? Now, and I mentioned this when I started, but there are several sort of natural pause points in this presentation, the way it's structured. So when I get done with this section, maybe we
Yeah,
can
because I try and get them out by 3:30 and it's starting to snow.
Okay. Well, so we were here on this slide looking at sort of the composition of the share by filing status. Again, we'll look at here the composition of people claiming who do have kids and people claiming who don't have kids. For a long time, relatively stable, kind of like what we saw with the composition of filing status. But again, because single people don't have kids by definition, in terms of filing status, with that big influx of single people, you see for the first time more people claiming the credit than not that don't have children.
Why? Is it because the kids maybe have aged out?
No, so this particular one has to do with the ARPA changes
Okay.
at the federal
Okay,
level.
I missed that. So I will go back and read.
So I did provide a quick explanation. What they did was they dramatically increased the income thresholds for them. So by that way, thousands of people really became eligible. And the other thing they did was effectively tripled their maximum credit amounts for that 1 year, and it was temporary.
And we do have the governor today that will make sure those numbers.
I've already I've already poked at it initially, so happy to talk about that. So there's that jump there. This is sort of a breakdown of the share of EITC based on what income bracket that they are in. So we go up to about 50,000 is sort of where most of these filing stats, depending on how many kids you have been phased out at that point. But you can see here that the portion of the number of claimants who are earning $25,000 or less is well over half. So that just sort of illustrates that the credit is by and large mostly being claimed by Vermont's lowest income taxpayers.
Do you break that by age?
We don't have, so that's kind of a difficulty we have a lot often when we're looking at sort of tax data because it's not so easy to tell how old taxpayers are based on, you know, what's on the form.
Oh.
Okay.
Um,
Could
I'll put my
this
birthday. It's not,
twenty
just-
twenty-one, could it, you could be on unemployment and claim this, right? Could that be part of the jump that year, that people's income were, there were more people with low income because they were laid off and
So
picking up unemployment?
you're asking a very good question because the answer is a little bit different than you're thinking though.
Okay.
But so you do see here that there's a big jump in people between 10,000 and 25,000, right? We'll get into this when we talk about single payers, the effect ARPA had on them, but that range of income right there pretty well translates to what the increase in eligibility was. And so that's capturing a big group of people who became newly eligible for the credit. But yes, that's a good observation. So this is where we start to get into major findings. So if you would like to pause.
Yeah, probably.
I'm happy
This
to
would
come
be a good place. And it's gonna be, because you can get EITC, you are going to get an increased state credit for child and dependent care on your federal taxes. Plus, you're going to get a refundable child tax credit in Vermont. I know EITC doesn't count against your income because that's why we've done that rather than increase subsidies somewhere else because it gets you thrown off other programs. And I'm wondering if we figured all those tax credits in, what the actual income, what we've done to the actual income of people.
Right.
And see where that is.
Yeah, I mean, you're right that you know, there's a whole constellation of credits that are available to people with kids.
Different for every single family. It'll be interesting. Because we keep wondering why Vermont is so much more expensive. But our wages are lower. And we never, who asked about why are our wages lower? We aren't primarily a farmer, agricultural. The farm has always been a different set of calculations. But we aren't, and I'm wondering, that was always our one economic flaw. We had a good workforce that worked for less.
Do you call it,
I thought, yeah, I thought that was appalling, but all right.
switch to Boston Federal Reserve, write articles about it.
Yeah. Probably where I'm
Very,
Okay. So thank you committee for hanging in while I did my press conference.
Thank you, Madam
I
Chair.
said it, but we will be looking at the governor's proposal, both childcare and the money that he's proposing to put into that and how that figures out. This committee was the one that found the money we wanted. And we'll take, we'll be looking at some more. I guess when the tax commissioner comes in, we'll be hearing about military pensions. I'm just going by what we did last year, which is we treat everybody equally. And everybody pays the same percentage, and that's what we did for military pensions. But I want to look at the raise in Social Security benefit, because I guess the new cost of living, according to the governor, will push more people up against that threshold. People that were eligible last year, they got a cost of living, and now they won't be paying taxes. So we'll look at that one. Tax commissioner is coming in next week, so follows his previous performances, we will have a great advocate for the governor's proposals.
That's his job.
Right.
And one that advocated so well and so strongly. So anyway, I think that's it. Thank you, everybody.
Safe drive, yeah.
We'll do my best to make your head serve. when
I will
get
have to
it.
go back and read it. And I think it's the next part. I was told by Ways and Means was very interesting.
That it's getting good reviews. Spent a lot of time on it this summer.
Yeah, well, that's good. Because these aren't the kinds of things that you frequently get told are very interesting. So we will,
I'll take that as high praise.
yeah, it is coming from a money committee. Okay.